So thank you for tuning in to the Compassionate Capitalist show today. And thank you for choosing this show. We know you have many business podcasts that you can listen to, and I appreciate you tuning in to listen to disclosure and transparency and angel investing and subscribing to the full series. You know, if you're new to this program, it's been around for a decade, something. There's 200 some on. We screened we archive some of the shows. Some of them we reboot, we redo, or we repurpose. And this topic is actually one of those that we repurposed because I have been in a couple of, as we're back to getting face-to-face business meetings. Lately, I've been in a couple of conversations and discussions with people at networking events. And I was at a big entrepreneur conference recently. And transparency and disclosure and understanding what you should look for in due diligence is something that seems to be lost a lot of times on even experienced angel investors that have been through this, and it's something that's really necessary for new investors to appreciate, because it's so much different than what, and I say new angel investors, it's so much different than what they experience when it comes to investing in public stock or investing in real estate. So I was going to just repurpose and look at, what I had recorded before, because I've talked on this multiple times, and said, you know what, let me just do a whole new one. So this is a whole new fresh one, just me. I didn't have a guest lined up for today's show. So I decided I'd cover the topic myself, and I'm probably going to bridge this into a talk discussing value and unique value proposition and things like that. But for this one, we're talking about disclosure and transparency and in angel investing. And for those of you, I'm Karen Rands. You might have heard that in the intro. So I'm Karen Rands. I'm the host. I'm the founder of the Compassionate Capitalist Movement. And I am, the host of this podcast, and which I've been for many years. And what is it that we do that's, might be new to you, and how does that relate to this idea of compassionate capitalists? Well, when I wrote the book, for those that are watching, I'm pointing to my book right now, Inside Secrets to Angel Investing. It was built upon the foundation of a electronic series that I had created to help the investors in my angel group become more comfortable with the idea of writing a check out of their own personal checking account to buy equity in an angel. In an angel-based deal, like a startup or an early stage company. And prior to that, when I had been being mentored by the founder of the Network of Business Angels and Investors, which I had taken over about the time I wrote this book, because I had people asking me for information and education about being an angel investor, and there really wasn't anything out there for it. There's some stuff now, and there's exclusive stuff, but nothing for the general public to learn how to be an investor in a private entrepreneur company. So I wrote it. Then when the Jobs Act came out, I wrote this as a real primer, step-by-step guide. And eventually I'm working on it. It just dawned on me I should probably create an e-course to mirror this book. And I don't know why I never did that before, but I'll be working on that. But the purpose of this podcast and what we do, what my organization, Cougaran Capital Holdings, does, and the purpose of so much, the mission, the Compassionate Capitalist Movement, is to help an investor like you that are listening today, or an entrepreneur that has potential to be highly successful and then become an investor and entrepreneurs also, is to learn the rules of the game for creating generational wealth by investing in the passion of an entrepreneur that has a novel idea and that has potential to transform a market, create a market, and benefits mankind. I know that's really idealistic, but that is what angel investors do. That's what makes them compassionate capitalists. And that's sometimes why they're called angels, because they are benefacting a company that they want to make money in. That's the capitalist side, but they're putting their money to work with passion, for the passion of that entrepreneur and the innovation that they're going to bring to market, the jobs are going to create, the ripple effect that has within the community, the compassion of that capitalism to make money, but to do it with a specific intent. So different from sustainable business and conscious capitalism and those kind of things. This is specifically to an individual that is investing money for a specific intent, which is to create wealth and benefit the community, the world, with whatever the innovation that's coming out or whatever that services that entrepreneur offers, and the jobs it's going to create and the wealth it's going to create that has a ripple effect to benefit that community. And so so that is the compassionate capitalist movement. And this show is a platform to amplify that message. It's a complicated message. And I discovered that, just like myself as a executive in IBM, when I left IBM to go be a part of this world of venture capital, I had actually never heard of the term angel investor before. It was a brand new term to me. And it was completely logical. It was, perfectly made sense that there were individuals in between a company's, a founder's credit cards and personal loans and, to where a bank would loan them money, that there was, a something in between. And that turns out to be angel investors. And when I started interviewing angel investors, when I was taken over to be mentored and then become the manager of this organization, the Network of Business Angels and Investors, and I asked these investors, how did you become an angel investor? What made you want to become an angel investor? And they usually, almost all the time, said, I got invited by a friend of mine. I came into some money because they had a liquidity event at their company. They got a golden parachute. They had somebody in their household died, or somebody, they got, a will, a benefactor from a will, an estate, something like that. They made a bunch of money with a good stock play or with a real estate investment, and they had other money that they wanted to diversify and put into a different asset class. And they heard about this idea of investing in entrepreneurs, either from a friend or because they followed tech magazines, or they'd seen, back in the 80s, it might have been because they saw Microsoft and Apple go public, and they realized that Microsoft created, what was it, a million entrepreneurs, millionaires from their public offering, from their employees and different investors that had invested along the way. And they're like, I want to do that. I want to be a part of it. Just like me, I wanted to be part of the parade and not watch the parade go by in the .com thing. And that's a whole nother story. You might have to listen to a different podcast to hear that, because I do tell that story often. Anyhow, so so I realized in talking to these folks that they almost always lost money in the first few deals. And the reason why they lost money was because they didn't know the questions to ask. And then in hindsight, they would say, oh man, that's so obvious. I should have known to ask that. And that's a horrible way to learn how to be an angel investor. But if you approach it and you get education, you get my book, Inside Secrets to Angel Investing, you listen to these podcasts or you watch the videos where I talk about this stuff, then you can learn how to be a successful angel investor the way people learn how to be a successful stock market investor, a successful real estate investor. Yes, there's always risk. And yes, there are. And yes, in all of those cases, there is a fundamental process to go through to validate a deal once you've identified it. In my book, I talk about that. I have due diligence lists. I talk about all of these things in the book. So that's why I do this. And since I'm not introducing somebody, I'm introducing myself. I'm taking a few minutes to share this because this show is starting to become actually pretty popular. And I sure hope you'll share this as well. So some people may not go back 10, 15, 20 podcasts to hear some of this stuff. So I'm revisiting it. If you've heard it all before, I apologize for you to make you listen to this again. But So, this is part of it for me. Is my mission is to bring into the marketplace in the next 5 years. Now, this sounds like a small number, but when you talk about people that have allocated a certain amount of their capital to invest in entrepreneurs and are actively seeking to invest in entrepreneurs outside of a structured angel group. And there's a whole other set of reasons why that's the case, that happens. But whether it's investing in the business down the street or a Reg A plus company or a Reg CF company or something that their brother-in-law told them about, whatever that is, that they have a firm set of criteria to be able to evaluate that deal and diversify their portfolio to invest in entrepreneurs, because the greatest source of wealth creation is to be a successful entrepreneur. The second greatest way to create generational wealth is to be an investor in multiple successful entrepreneurs, because you're only owning a piece of the company that has become successful. So to be as successful, you must do that multiple times to get a piece of each of those entrepreneurs' success. All right. So my mission is to bring 1,000 well-trained, confident investors into the marketplace to invest in entrepreneurs, those startups that inspire them, as well as the small businesses in their community that bring value to the fabric of that community and deserve to set their roots there in that community, but scale to be a nationwide or even a worldwide business, because they draw upon the potential of the investors in that community to support them, lift them up, and share in their success by helping them financially achieve those objectives. All right. That's my goal. That is the National Network of Angel Investors. All right. That's a virtual angel group that people, when they buy my book, get a free membership. So it's not much, and the book's only $20. All right. This is about as charitable as I can get. And they have the ability within that to bring deals to me, to help them with due diligence, to be able to syndicate with the other investors. And so very much like the way a traditional angel group works, but it doesn't have the commitment of the time, the geographic restrictions, the industry restrictions that most angel investor groups. You have the ability to look at the things that you're passionate about, your hobbies, your industry knowledge, things like that, and be able to validate them, and then also help get the help to syndicate with the other investors on that, or the next stage of that company, to get access to the VC or the additional funding, or to do a hybrid of crowdfunding with a traditional investment. And they may have an angel investment from an angel group. Sometimes we have investors that are part of an angel group too, that are part of the National Network of Angel Investors, that have a deal that's not in the bailiwick of that particular angel group. And they still like the entrepreneurs, they still like the innovation, and they want to see if they can pursue that outside of the angel group. So my 1,000 are people that are operating outside of a traditional angel group for deals that are not in that group, or because geographic or time, they're not able to participate in the way that most traditional angel groups work. All right. So that's 1,000. Maybe you'll help me be that way. All right. We're about 1/10 of the way there. So, all right. And so with that, transparency and understanding that is really important. All right. So here's the deal. So let me explain this to you. And I have to do this by starting with some real fundamentals that'll be like really common sense to you as you hear them, right? So the thing that you have to understand when it comes to security offerings is that up until fairly recent history, there was really only two types of equity offerings that deal with private companies. And that is a public offering, a public stock. That's a stock like that's available on the stock exchange. Those are your Apples and your Home Depots and your IBMs and your, this thing, McDonald's, Delta, right? All of those are public companies, and they that people that own those buy and sell with each other, and they hope to make money on it. The company really doesn't benefit from that, right? That's why it's not compassionate capitalism. It's just capitalism. It's buying and selling. They get to benefit from the value of their stock if they continue to grow it, because then they can leverage other things with that, and they can buy other companies with that. They can get really good financing based on their valuation, their market their marketplace, in the market valuation that they have based on the value of their outstanding public shares, right? And then you have private stock, private equity. And so a real big distinction between those and private stocks are what traditionally have been angel investor Reg D offering, Regulation D. It's the exemption that was put in place back in the 1930s after the collapse of the stock market. And they started a lot of these regulations to even on public stock, because public stock there, that's where that came from. There was a lot of non-transparency in that. And so that non-transparency, similar to what happened with our real estate bubble, okay, that caused that great recession of 2007 to 2010, 11, 12, whatever. It was lack of transparency. Okay, so in this particular case, public companies were required to file a lot of documents to initially go public that would disclose all of their financial history, their current status, all kinds of things that they needed to disclose that would establish what the risks were in making that investment. And then private companies didn't have to do that, okay? But at that time, there wasn't an exemption for private companies. So private companies had to, basically the most wealthy out there, because again, the greatest wealth is created with the greatest entrepreneurs and those that invest in them. So the Roosevelts, the Rockefellers, the DuPonts, the Hiltons, the all of these entities that you hear, the folklore, and actually our generational wealth that we still have today, were the mavericks that were doing railroads and hotels and starting businesses and doing all of these things. And they like to invest in each other's businesses, but they didn't want to tell everybody about that. So they lobbied to the SEC to create rules that gave them an exemption to not have to disclose that information to the government or the public. So the private information, that's why you have some big companies that remain private, even though they're doing hundreds and even billions of dollars in revenue. They're still private, right? Because they don't want to have to disclose that information. And so when they disclose, they got these exemptions, and they materialize into 504, Reg D 504, 506, and some other things, but those are 505. But the ones that most people pay attention to and angel investors participate in are 504 and 506. All right. So fast forward, we are in an electronic age. And, a big differentiator between public companies and private companies is this ability to general solicit. That means you can ask the public, you can generally solicit for investors to invest in your company. And public companies can do that because they have disclosed publicly. So they announce an IPO, they get people to invest. There are people who invest privately just before they go public, but all of that stuff has been disclosed. And afterwards, every year they have to refile information. Okay. And they get into big trouble when they don't file properly, or they don't do their financials properly. Think Enron, MCI World Telecom, right? There's been companies over the years that are now household names because of their lack of disclosure or truthful disclosure, right? So when we had the Great Recession as a result of, we had some problems. Okay, there's the Dodd-Frank, and I cover all of this legislative stuff in my book, but in an addendum. You don't have to read it all unless you want to. But the Dodd-Frank Act came out with new rules for additional disclosure requirements because of some of that lack of transparency and lack of truthfulness that these public companies were doing. And then it made it even more of a burden on the private companies or companies that might want to have stayed private and the private part of that. But we have a public world. And with the advancement of the internet, and then as the resulting economic malaise of the stock market, of the real estate market, and then ultimately the stock market and the financial markets, when the lack of transparency between mortgage financing and the selling of notes, and the merging of how these financial institutions were investing their money in those types of transactions. We had the collapse. I did a podcast on that. And so we had that collapse. But also what happened to it, because it was the first time that something like this had happened, and the angel investor money kind of dried up. And angel investors, and why this is called inside secrets, angel investor groups have typically been, and the reason why me as an executive didn't know about it is that they've been very exclusive in their operation and their structure. Somebody knows somebody, or it's usually people that have exited out of a tech company, so they understand tech. They invest in things that are local, so they can go check on them and make sure and help those companies. And so it becomes very tight-knit within a community, and it's really difficult to break out of that. I had great difficulty when I was rebuilding my angel investor group to get angel investors from other organizations to come in and help mentor my angels to be able to be comfortable with that. That was, again, part of why I wrote the book. They didn't want to help others. They were like, let them lose money the way I lost money. They just think, what? Okay. So what you have is the Jobs Act of 2012 that established these rules that companies, entrepreneurs can general solicit. They can do it there's really 5 ways to sell equity in a company. You can, 4. One is the reward base. That's the crowdfunding that you know about. But you got interstate, where people within a state companies in a state can solicit investors in a state. You have Reg CF. That's a national program that I'm not going into all the detail of this because I want to get to my topic in the next 10 or 15 minutes and explain this to you, but I need to set the stage for why it's really important and why the burden is on the investor. All right. Okay, so you got Reg CF, Reg crowdfunding. You got 506C. So interstate is the old 504 that they expanded to allow for general solicitation. All right. And accredited and unaccredited investors. That's a topic that you should look up if you haven't, or read my book. Reg CF. I also go through all of this and explain each one in my book. Reg CF. Then you have 506C, which is only accredited investors who can general solicit on a national basis. And then you have Reg A plus, which is sort of like a backdoor, easy way in, an alternative to pink slips and reverse mergers for companies that are established to raise capital on a national basis and then have a pathway to go public. And it also allows existing investors in that company to sell their stock at that price of the Reg A if they want to get out for some reason. Okay. And so that was how companies could, if they follow the rules for those types of offerings, they can general solicit to the public. So now they can target an investor the same way they might target a customer. They figure out who is it in there that would like this kind of a deal, who they like their kind of product, they like their kind of offering, they like their region, and they could be people that are just savvy stock market investors. They can be people that, are their customers. They can be their partners. They can be all kinds of folks that get what that company is doing. And then, there's a whole lot of people that just do that as something fun, a way to play the stock market without playing the stock market, kind of a thing, because you're betting that out of these 10 companies you invest in, that some number of them are going to be highly successful to create great wealth. All right. So that's the difference. So everybody talks about the ability for entrepreneurs to go raise this capital, but they rarely talk about the ability or what the issues are for investors. So part of the thing for investors was that we had a big problem when that collapse happened. People lost a great deal of their retirement portfolio that was in the stock market. If they had been investing in real estate as a retirement plan, they lost that value. And traditionally, if you look across the scope of angel investment compared to those others, angel investment on average has a 3 times rate of return as a stock market or real estate. Real estate averages around 8 to 10%. Stock market averages around 10 to 15% over a period of time. And angel investing averages out internal rate of return about 24 to 34%. All right. So it's considered a highly lucrative way of investing, but again, it's risky. And part of it is this point. Those companies are not obligated to share anything with the investors unless, like they do with a public company. The only ones are Reg A pluses, but even then, not necessarily. They have to file audited financials with the SEC, but there is no viewpoint of whether it's a worthy company or anything else. It's just the financials. And on Reg CF, they have to list this stuff. That's probably the closest you're going to get to having an entrepreneur fully disclose their issues and somebody vouch for it that's in a startup stage, because the Reg CF platforms are licensed through FINRA, which is a regulatory arm of the SEC, not a real government agency, that validates broker dealers, investigates fraud, investigates disputes with investors about investments, and they hold broker dealers accountable, and they also hold Reg CF platforms accountable. And so with that, those are the ones, but all the other ones, the intrastate, the 506C, and again, to a certain degree, the Reg A plus, it is on the investor to ask for the information. Now, under a traditional 506, a company has to do a private placement memoranda, and in that, they're supposed to fully disclose, but they may not disclose, okay, certain things that they're not obligated to, and they're expecting to be successful and the investor to make money. So therefore, there will never be a dispute as to that entrepreneur not disclosing or conducting fraud to be discovered in that. So part of the ways that an entrepreneur might not disclose things that would be real deal killers if they're using finders. Okay, how are they raising their capital? So one of the things I always tell companies that you need to, investors, you need to ask for the cap table. You have to sign a non-disclosure for this stuff, so be prepared for that. But you ask for the cap table. You understand how much they've raised capital, how did they raise the capital, who did they raise the capital from, right? If they are required to, if they did it under a general solicitation, there's certain rules that they have to adhere by that. If they did it under a traditional 506, and then now they're doing a general solicitation or a 504, what tracking did they do of their unaccredited investors? Did they fully disclose? Did they keep those folks the records of who was accredited and who wasn't? Did they get investor questionnaires of all of those supposed accredited investors? That means they sign off, and that investor signs off that they are accredited, okay? Because they lose some of their rights if they lie about whether they're accredited or not, right? Then the next thing they have is you want to know, did they raise the capital at a stair-step thing? Because sometimes they'll be all over the place and they'll just take money at whatever they get because they're desperate for money, and that's a recipe for failure. And then they will use finders. And depending on the structure of how they use that finder, investor acquisition's not bad if it's done as an employee or a contractor of the company. And that person, because that's what I do within syndication, that person is doing other stuff for that company, that they are responsible for some business of that company. And they are also gathering investors up and not getting a commission on it. They're not acting as a broker dealer or registered anything, a licensed anything when they are doing that function. If they're just finding capital and collecting commission, that's a no-no. All right. And if that entrepreneur is a bad actor, so a bad actor happens when they've done some of these other things they didn't disclose, and as a result of them not meeting a milestone or making a success element to it, investors have the right to sue. And the investors file a complaint with the SEC. The SEC investigates. If they find that that founder or that executive people did not disclose properly material information that would have affected your decision in investing, then that is considered fraud. Then they are considered a bad actor, and you, the investor, have the right to get all your money back from them at what you would exactly what you paid for. That company goes out of business. They also might pay fines. That CEO might go to jail, or that founder might go to jail, depending on how bad it is. And fraud's illegal. And then they become a bad actor. And then on the general solicitation rules, it's very specific that a founder cannot be a bad actor. They're supposed to disclose that. But why would they disclose that if they're trying to start up another company? And they can't own more than like 10% of the company or something like that. And they can't have any fiduciary responsibility. So you need to find out that piece of it, right? Then you need to know, based on what they raised in the past, what was the use of funds on that? What did they use that for? What did they document that? It's a lot of it's documentation. When they hire somebody, when they got somebody to develop their software, do they have full rights for that software? They didn't. They did it under the right kind of contractor for software that all the rights to that are owned by the company. Do they have any disputes with sexual harassment or anything like that, or racial discrimination or any kind of discrimination, right? Do they have any kind of lawsuits on that? Have they paid all of their taxes, payroll taxes included? That's not just on, now on a Reg A Plus, they would have to disclose that stuff, but other ones, sometimes they'll give you a pro forma and they might give you some of the stuff, but they don't disclose that stuff unless you ask them. And if they hesitate, that is your warning sign to say no, next. Because there's always a good deal that you can get. And if you don't fully disclose it, there's a whole bunch of other stuff that I cover in my screening process. And some of this is stuff just enough to figure out if they're worthy of the next step of due diligence. And some of this stuff you'll only discover under full due diligence. But these are the things that you must look at, because it is responsibility of the investor to get that entrepreneur to be transparent and disclose that stuff. And then the next piece of transparency is to make sure they have established what is going to be their communication process for the status of their company. At the very least, it should be semi-annual, that they do a full disclosure and have a Q&A session like a public company does, that says, here's our current status, here's our current financial situation, here's the current status of whatever product we're rolling out, here's our current hiring process, here's our current. So are they progressing the way they should? Because they should want to do that, and not, because even bad information is good information, because then the investors can help move that company along or agree to put more money in to get them through that, because maybe they didn't realize they needed to raise more capital, or they waited too long to raise capital. They missed the VC boat, and now they need to be able to get the capital from like a general solicitation. But it costs money to go out and raise that. So they might have raised an angel round, and now they're trying to bring out a new product or expand into new markets, or in that local community, expand into other states. And they want to do one of these general solicitation offerings, right? And so they need money to do that. Depending on how much they raise, it could need anywhere from 50 to 100 grand to go raise $1 million, $2 million, $3 million, $5 million in legal fees, preparation fees, accounting fees, marketing, investor acquisition fees, to help them with their launch and strategy of communicating their campaign, advertising fees, regular, because they can advertise. you can advertise under a general solicitation. You don't see a lot of the people doing that because they don't really understand how to use advertising that way. I do, but they don't. So anyway, that is a piece of this puzzle that you as a current or future investor need to understand when it comes to the burden of getting due diligence information and the transparency of disclosure of information. Good entrepreneurs will put together due diligence. We work with entrepreneurs to put together a due diligence package. We put it up on a portal so that they can give a password access to potential investors, and you can go through that. And I tell companies, if they're running something under general solicitation, they need to have the level of documents and the quality of information like a public company, because the odds are that investor is never going to meet that entrepreneur directly like an angel group meets their entrepreneurs. And so you have to be able, as an investor, use your business acumen, your ability to discern public stock information and whether a company is a good investment, and use that to discern whether this private company's offering is a good investment as well. Keeping in mind that they may not have everything because they are still a small company, but whatever you're investing in should be stair-stepping up to be the equivalent of what a public company value might be. That's what the benefit of buying wholesale before it goes retail. And with that, I say onwards and upwards. Thank you for listening. If you like this, 5-star it and share it. Have a great day. Thank you for listening. Karen Rands. Please go to karenrands.co to get more information and connect up with me through my contact page. Thank you.